Hello, my fellow investors, and welcome to the quite possibly the most insane week that we have had for a while. And it's only Tuesday. We still have 3 more days off of this nonsense, and it's just absolutely insane. So we're gonna cover a lot of stories today, guys. A lot of stories. And with me, I have here my partner in crime, second in command. Introduce yourself. Don't laugh. Introduce yourself.
Hey, I can laugh whenever I want.
That's very true.
Michael, how's it going?
And
Mr.
who are
TA
you?
over here?
Yeah, Mr.
TA. You know, superior to fundamentals.
Hey. Watch yourself. Voodoo magic does not count here on the channel. Just saying.
No,
Anyways.
That's all that matters. All that matters is voodoo magic.
No, it doesn't. Anyways, guys, today we are going to cover a whole lot of stories because it's just been crazy. And the first one that we're going to cover is the one that you're seeing here on the screen, and that is none other than CPI came out today, and to everybody's surprise, it actually came down. Now, I actually put out a poll here on the channel a few days ago. Right? Like, I would think it was like last week or something, asking everybody, hey, what do you think CPI will be? And most of you guys actually said that it was going to be between 6.0 to 6.4. Some people said that it was going to be under 6. And, well, guys, CPI came in at 6% on the dot for the 12 months. Now, over here, though, you can see that in February, consumer price index for all urban consumers increased 0.4 seasonally adjusted and rose 6% over the last 12 months, not seasonally adjusted. The index for all items less food and energy, otherwise known as core CPI, increased 0.5% in February, up 5.5% over the year. So, what do you think about this boy? What do you think about CPI going technically down to 6.0?
So I actually have an interesting topic that I was researching beforehand.
Go on.
If you look at the individual data,
we're gonna take a look at that right now.
Yeah, and I'm gonna term it the CP lie because in the one there's 2 items. So you have a disclaimer in the CPI that say the report is subject to some sampling bias.
Oh, okay. I thought you were going to talk about this up here.
Well, that too. Well, let's not get into that. But let's just talk about you have. The report, it states in its opening covers that it's subject to sampling bias. Okay. So basically, they added that probably mid last year, if I want to be exact. But if you look at it from a complete overall perspective, they can cook the number whichever way they want. And you don't think that. If we remember the 2008 crash where Freddie Mac and Fannie Mae were rating AA bond, then AAA bonds and freaking double C bonds as double A's and all that, if you think you can't, that was able to happen, and now you basically, this is just number game. You can cook these numbers very, very easily. Now, I'm not saying it's flawed one way or another. I'm not saying that. But I'm saying is what they can do is they can manipulate certain categories that are higher subjection to sampling bias than others to then skew the results whichever way they please. Well, we also covered this in the weekend deep dive about how the option chain was.
Yep.
Where they paid out a tremendous, and I mean tremendous amount of premium last week where it was extremely bear-sided, where you only had bears to burn and you paid them all. If you paid off everything but 385 chain on the S&P, you're going to quad witching this Friday, which is the
Is it this Friday?
Yep, the option expiry of
March
future
17th.
Contracts, equities, Forex, and commodities.
I did not know that it was this Friday.
Sectors.
I did not know that it was
this Friday.
But
it's quad witching.
Wow. But anyways, no, I mean, I don't know exactly how accurate, because unfortunately we have no idea how they're actually cooking these. By the way, I fully agree with you that yes, majority of these numbers, I think they are very, very much skewed.
There's one that stands out.
CPI, well, hang on a minute. So CPI says 6%, right? Overall, it does not feel like 6%. I don't know about South Carolina, but here in Pennsylvania, it does not feel like 6% at all. So I have no idea, how they're weighing this, but I'm actually looking right now. Like you can see the screen, right? I'm looking at right now the individual categories, and we can see that right here, food at home, 10.2%. Specifically, when it comes to cereal, bakery, and products, 14.6% increase. Meats and poultry and eggs, 6.8. That to me kind of feels off, doesn't it? 6.8.
I wonder if you actually because I want to cover one category in specific, and that's used car prices.
Let's go down to that. I believe right here, used cars and trucks, negative 13.6.
So this is why I'm saying the number is cooked. Because the Manheim Index, which is, if anyone is in the car industry, you know exactly what this is. This is your gold standard index to understand what car prices are at. Most used car prices are priced against it because it's just the gold standard in understanding the market value of cars. It went up 4.5% last month. And CPI is saying negative 13.6% year over year. And then if you dive into the report's actual numbers from the December to January jump, it's saying down 2.8% in January. And I'm just like, that makes no sense whatsoever. And then negative 13.6% on this most latest report for the month, from month to month. Well, I'm like, no.
Well, to be fair, it's not just this one either. Like, it's also gasoline. Gasoline went down 2% of all types. This is gasoline of all types. And actually, but energy is now 5.2. So like what, a year ago, 2 years ago, like 2021, gasoline was like all-time high. Remember? Oh, not gasoline. Energy. Sorry, energy was just like spiking through the roof. That was when we got. Well, what was the highest gas prices that you got in South Carolina? Because here in PA it was like 415, 410.
I think it was like around 4.5 at the height.
4.05, you mean?
No, 4.5.
No way. There's no way that in South Carolina was higher than here. There's no way.
Or that could have been premium.
Okay, yeah.
I know.
Well, you buy premium because you have a Corvette, Mr. Flex over there. But for us normal people that buy unleaded, regular unleaded,
Yeah, but I think I do think that it was. I do believe it was around the. It was. Let's just assume like upper fours, mid five, like lower upper fours. Let's just put it that for, because a nationwide average. Let's take that as an average. That's a good metric. It was $4 or $5 a barrel.
Yeah.
But basically, that's how I would view it. Where energy naturally is coming down, has kind of been stagnant. Where you saw in the last month. But again, I'm going to keep harping about this until I'm blue in the face. If the Manheim auction index is basically saying 4.6% increase in used car prices, and CPI saying on the month over month the decrease of a 1.4%, that's a 5% skew in the data, and it's just like it's how you basically manipulate it to do whatever, because used car prices are so subjective and everything of how they selected. Food is a little harder to manipulate because it's just a category that, well, whatever you look at with food, I don't think you find anything in the grocery store that is cheaper than last month. It's like,
that's not true. That is not true. That is not true. There are hot dogs that are going like $4 for $5. So I don't know how nutritional that would be.
Yeah, what they did is they were charging you that same price for $5, so they just took one hot dog out and they gave you the 4-pack instead for the same price.
Is that the way that they did it? But yeah, man. So we got 6% for CPI. The people that voted on the poll, majority of them got it. They got it again. So far, they've been pretty on it. The only time that they were wrong was last month, where they thought it was going to be less than 6, and we got 6.4. So that's a thing. Overall, though, I mean, core CPI, it still came in at 5.5. I do not remember what it was last month. I don't know if you remember, but
I can pull it up, bro.
You can pull it up. All right. Well, when you pull it up, just say it. But yeah, so that was CPI for the month of February 2022 and 2023, and next CPI, which would be on for the March month, it will be on April 12th, and if I'm not mistaken, that is on let's see, April 12th is on a Wednesday. Okay, so yeah, we're gonna be live streaming that once again. Now that we covered this, guys, I want to go into the next story. Boy, do you want to...
Did you find it? Last month for core.
5.6. So we went down by 0.1.
Yeah.
That's still sticky.
You know, what they did sticky. Is it stayed flat, but they rounded it down.
Right. Okay. Yeah, so it's still sticky, though. But okay, so that will pretty much do it for this main story. I actually now want to come over to the main part... The main thing that's been happening these past, 5 days, I would say. And we did do a video about this, but just as a quick recap, guys. Silicon Valley Bank. And I'm pretty sure this is all over the internet, all over YouTube. But you know what? I'm going to do it because clicks. I'm going to do it because mainstream. So Silicon Valley Bank, for all of those of you who do not know what happened with this bank, they went under. They weren't like a big bank. I mean, they were in the S&P 500. Don't get me wrong. They were pretty big, but in comparison to like a JP Morgan, Bank of America, Citigroup, they weren't like major, right? They were a regional bank that mainly their customers were mainly Silicon Valley companies, upstarts, companies that want to do like IPOs and that kind of stuff. So they went under, and I love it too because look at this notification, boy. Look at that notification right up there. You see it? Or nah?
Wow.
Yeah. So like, you want to read it for me, or
the bank is open for business?
You want to read it for me?
Sure. Silicon Valley Bank N.A. is a newly created, fully serviced FDIC operating bridge bank. Well, you're being really operated by the FDIC now.
Yeah.
The bank is open for business, and new and existing depositors have full access to their money and protection for their deposit. Details for counterparties, read more at fdic.gov. But that's basically like once the FDIC took over. Yeah.
Oh, this is awful. So this happened. They completely went under, and this is just brought like a litany of just like chaos all over the markets. But if you didn't see any of that happen within the past 4 days, within the past 3 days, and you saw the markets today, you'd be like, I have no idea what you're talking about. But let's actually come over here, because apparently now Silicon Valley Bank, closed by regulators, FDIC takes control, as we saw, right? FDIC has fully taken control, and according to them, they are not going to bail out the banks. However, or specifically this bank. However, they are going to bail out the depositors, which is interesting. The issue with that statement is that you're only insured up until the first $250,000, period. End of story. So all of these companies that had like more than 250,000, a million. Yeah, pretty much all of that. Roku, right? Because we also covered that too, right? Roku had a major portion.
500 million.
500 million. Oh dear Lord, $500 million in SVB. They're only getting 250,000, not 250 million, 250,000. That's stupidly small. So yeah, FDIC takes control. Great. I don't know how well that's going to do for the rest of the companies that had their money in here that had more than $250,000. However, though, there is something else that happened, and that is that another bank actually went under, and this one was Signature Bank. Signature Bank, I believe, went under like the following day, right?
Once the FDIC seized the bank, they seized SVIB right around 10 o'clock on Thursday.
Yep.
Or Friday. I can't remember exactly. And then after close, Signature got seized.
Right. And the funny part about this is that, I mean, if you guys are looking at the headline, Signature Bank's closure had nothing to do with crypto. So this bank, apparently, boy, I don't know if you knew, but this bank had a lot of, I don't know if it's a lot, but had some exposure to cryptocurrency, specifically Bitcoin. And that's why a lot of people were like, oh man, like, they closed this because of Bitcoin coming down, right? But now we're getting this story. And by the way, guys, this is from, if I'm not mistaken, this is from Reuters. So, right here, Reuters. March 14th, Reuters, New York financial regulator said its decision to close. Take a look at this. New York's financial regulators, so not the feds. New York's financial regulators said its decision to close Signature Bank had nothing to do with crypto, citing that it called a significant crisis of confidence in the bank's leadership.
What the hell?
I have no idea. Listen to that. Citing what it called a significant crisis of confidence in the bank's leadership. How subjective could you get? How subjective? Seriously, how subjective can you get? Hey, I'm going to shut down your business because I think your leadership isn't good?
No, it's like your leadership, they got their hair cut the wrong way, so we're going to shut your bank down.
Apparently, that's what that says, right?
Yeah.
That's
hey, KL, how's it going?
Ridiculous. KL, hi. Nice to see you. Nice to see you. But, yeah, like, this is, like, this doesn't make any sense. I haven't even read. By the way, I pretty much only read the first paragraph. What the second paragraph says. The comments from the New York State Department of Financial Services spokesperson were in contrast with those made by the Signature Bank board of members and former U.S. Rep. Barney Frank, one of the pioneers of landmark Dodd-Frank Act. Oh God, which has enacted after 2008 financial crisis to better insulate the banking system from shock. So. Because apparently Barney Frank came out being like, no, like this was fine, like we were good. Like he came out being like, no, like we have plenty of liquidity. Yet, look at this. This is
Yep.
completely insane. I have no idea. Something about SVB. I understand that one. I have no idea why this one went under. I really have no clue.
Well, it's also the question of, like, if you look at how all the banking stocks reacted, you're basically getting a 30-40% discount on almost all of the big six.
I agree.
But
the problem with that statement though is that unfortunately Barney Frank do I hear a question mark after that? I would say your name, but it's 1029384. Okay, yeah. Sorry, that's a really long name, my dude. Sorry. But yeah, Barney Frank. So the problem with this whole entire situation, right? You just said that all of them are at like super, I guess, discounts, right?
Yep.
The issue with that statement is that, well, the reason why SVB went under, that's affecting every single bank right now. Believe it or not, like, guys, everybody in the chat, everybody that may watch this in the future, every single bank, I kid you not, every single bank out there, even JP Morgan, is currently being affected by the exact same thing that caused SVB to go under. It is. And in fact, a lot of people are flocking to these banks because of, I guess, the safety in bigger banks. In fact, we just got the story right here, guys. JP Morgan, other big US banks flooded with new clients post SVB collapse. I guess they're finding, they're finding some safety in bigger banks, but the problem still stands. Every single one of these banks are in the red when it comes to the bond market. Am I wrong to say that?
No, all of them basically have the same issue, that they all are subject to the same pitfall, as we can call it. And the question I have, like, do we believe that with the sell-off, it's like it was targeted around one sector on companies that are extremely, extremely, extremely cheap? I wouldn't be surprised if we saw in the next earning reports, we bought back X amount of shares of the bank stocks, and all these bank stocks buying all these shares in the next earning reports, discounted prices.
Yeah.
To basically bolster their earnings.
Yeah.
Because the thing, let's be realistic. Like, SVB does not have the same corporate structure as JP Morgan and Bank of America and all of them, even though it's susceptible to the same failures. But those banks have so many assets that they can literally go to the federal government and say, hey, I need a loan for X, Y, and Z. And they're going to get it. Like, they're not susceptible to the same, smaller, they are in the larger sense, but they're not, they have access to different institutions like reverse repo to the everything else that a lot of these smaller regional, like a small regional bank can go to their reverse repo facility and say, hey, I need X amount of cash, or the repo facility, and like you're trading in the millions and millions is usually reserved for these big banks, these big players, especially the big six.
By the way, Stuffles just commented something interesting. If this was not part of a bigger problem, it should not have had such an effect on all the banking stocks.
Yep.
And but also, hang on. And 10, 29, 38, 47, 56, Y1. I'm just gonna call him Y1 from now on. He also said, it is a big opportunity for the big banks to consolidate money from the smaller banks into the big four.
Yep. Definitely.
Yep. It's almost like it's almost like a merger.
Hostile takeover.
No, well, yeah. It's almost like a hostile takeover or like a merger in a way, right? Because like, think about it. This was like a legal way. Kind of a legal way
to hostile takeover where you don't get thrown into a court battle.
Or exactly. Like where you don't talk about monopolization in a way, right?
Yeah. But the thing is, like, you can have like a vertical trust between all the banks, remember? You don't need to necessarily have
not even vertical, horizontal.
Yeah. You have 6 big banks. They already technically, like, if you look at the essence of the word, that they're already a monopoly because like I said, regional banks don't have access to the reverse repo facility, don't have access to the repo overnight lending rates from the Fed. They don't have access.
That I am not so sure of.
They don't.
Maybe
have
you're right, but
as much.
Okay.
As like any bank can go to them, but the thing is, like, who is gonna, like, in a liquidity crisis, who's gonna get prioritized?
Well, I mean, you're really going to compare the market capitalization of a JP Morgan to
SVB?
SVB? No way, right?
They're tiny.
Right.
Yeah, JP Morgan's first in line.
Yeah. But what I meant to say was mainly in regards to the fact that all of these banks are still suffering from the same mechanics that cause Silicon Valley to go under is this right here. And I'm going to bring up the big B word. Are you ready, boy? And it's not boy. The word is not boy. I'm pretty sure you know what it is, right?
Bankruptcy?
No, bonds. Bonds. Right? Banks are regulated. I should have had that pulled up. Banks are regulated to have a certain amount of collateral in regards to cash on hand. Yep. That's a federal regulation. So the reason, by the way, if anybody doesn't know, at least one part, I'm not going to say it was all of it, but the biggest part or the biggest reason as to why SVB went down is something actually really, really simple. And I'm actually going to pull this up on the fly right now. I was going to talk about First Republic, but I think, let's see if I could, I think it's SIVB, the ticker symbol for this. But the reason why, this bank specifically went down, it was because, let's take a look at the revenues here. When it came to this bank. So take a look at this. Over here, the total revenues. Boy, can you see the screen?
Yep.
Okay, great. So over here, in regards to the total revenues, you got 2018, 2.5 billion, 2019, 3.2 billion, 2020, 3.7 billion, and then 2021, $5.8 billion. They just had a massive jump in revenue from December 2020, 3.75 billion to 5.8 billion.
Which was the influx of all the cash into the system.
Well, that, and it was also the influx of all these IPOs, all these startups just coming into the market because of interest rates being super low, right? The federal funds rate at that time was near zero, right?
Actually, let me pull it up.
I'm gonna pull it up right now too. Federal funds rate. I actually have it right here. The federal funds
February 2nd of 22 is when the start of the tightening cycle happened.
Of 22. Yeah.
22.
Right. So that means that, well, actually, I'm here. I'm going to pull it up right now. So what I have here, guys, it is the federal funds rate. And if we take a look at around 2021, which was right here, I wish I could zoom this in, but which was right.
If you use the scroller on the left-hand side.
Yeah. You're absolutely right on that one. I am a noob. I do not use this website a lot. But if we do this, there we go. Look at this. Right at around, well, look at that. January 2021 to pretty much the end of 2021. What was the interest rate? Zero. Essentially zero. It was what, 0.08, 0.09, the highest that it got to? So what do we know, right? What do we know about interest rates, bond yields and rates? They're inversely proportional, right? Yep. So if you have the minimum rate being essentially zero, what does that mean about the prices of these bonds?
They're expensive.
They're very expensive, right? They're really, really expensive. Now, what happened is inflation kicked in. We got up to like 9% inflation, which I believe that those were like in August or something of last year. We got up until like 9% inflation. And then the Fed said, nope, we got to raise interest rates. So then that's when they started raising interest rates. Boom, 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 boom. We see this right. Actually, it was in February. We started seeing interest rates start to climb. And as of today, they're at 4.57%. What happens is, remember, interest rates and bond prices are inversely proportional. So when you have the base rate increase, what happens to all of the bonds? The prices of the bonds,
they go down.
They go way down. So if you bought any bond, 3-month to the 30-year, at around 2021, which I wouldn't be surprised if they didn't, seeing that banks are once again obligated by federal law to have a certain amount of collateral, i.e. treasury bonds, to cash per transaction that they make. If they bought any kind of bond throughout this time period, right now they're all in the red. Now the problem with SVB is that when they were doing this, because they were getting such an influx on these new startups, they were like, we need the bonds with the highest yields, which at the time was, which ones? The 30-year, because the yield curve hasn't inverted. It was the 10, well, let's just say the 5 to the 30-year, right?
Yep.
So they were pretty smart when it came to that. They just bought majority of their exposure when it came to the U.S. Treasury bonds, which again are the most safest bonds out of all of them. Well, they were all like a super late maturity. Interest rates go up, yields fall. Now as a bank, they still need liquidity. Problem is, all the bonds that they have are in the red. All of them. Or at least not all of them, but like majority of them. I don't want to talk in absolutes.
I want to actually cover the question that Stuffles has.
What's up?
About how many other small banks are at a loss if they had to liquidate all their bonds now.
Probably all of them.
It's not actually even the small banks. It's
all of them.
It's every bank in the United States is in the same situation from a loss perspective, because no bank or no sanely structured bank would be buying 2-year yields at the rate of 0% return.
Back in 2021. Remember that. Back in 2021.
So you didn't see the 2-year, the 12-month really taking off until about, I want to say mid 2022, where they really went on a absolute tear, spiking up significantly. Because like you see, it started increasing into 2022.
Look at this right here. I have it pulled up right here. In March 4th, 2020, the yield on the 6, this is the 6 months, right? The yield on the 6 months fell, and only up until 2022, the beginning of 2022 is when the yield started to go up on the 6 months, right?
Yep. And then you see that massive parabolic move
right here,
mid 2022.
Yep, right there. And again, remember, yields are inversely proportional to the prices. So if the yield at around, let's just say, let's pick a date, May 20th, 2021 was 0.02, which is crazy. the price of this bond was like skyrocket. Like it was just stupidly high.
And then also,
why would you buy it?
That.
Right? Why would you buy it?
Yep.
If the yield's so small.
And the worst part is that when you were looking, like not even that, like when their banks are buying it, they don't want to tie their money up for a low yield, because even if they, let's say that money that they allocate as a loan or a deposit that they then take out a loan, they want to make money on it. So they're not going to take a 0.02 return because it's a negative return. So not only did you have one, if this was just the only thing that was happening, I think you wouldn't see this shock. But also you have the Federal Reserve eliminating their balance sheet. So what happened when the tightening cycle started? You, one, had the Federal Reserve cutting its balance sheet. What's mainly on its balance sheet? Bonds and treasuries. They turn
and mortgage-backed securities.
Yep. They turn from being the biggest buyer, the biggest liquidity in the bond market. And they basically said the biggest buyer is stepping away from the table.
Not only just stepping away. No. I'm going to stop you over there. Not just stepping away, selling.
Yep.
Selling.
Turning from a buyer to a seller.
Boom.
And basically bonds went crazy. They basically, the bond value, right, yields up, bonds down, collapsed, spiking yields. And that's how you got this crazy mad run on interest rates.
And well, in regards to the whole entire aspect of SBV, this is the main reason why they collapsed. That's not the only reason. There are other ones, mainly political stuff, which we're not going to get into here because this is not a political channel. But the biggest one, at least in regards to the whole aspect of economics, this is it right here. And the fact that you have this happening right now, where people are flocking to JP Morgan and all that stuff, guys, just because, okay, JP Morgan, Bank of America, Citi, and Wells Fargo, they may have been in a situation where they, I guess, could have thought ahead, and instead of buying just, 30-year, 10-year maturity dates, they probably bought like some shorter ones, right? They probably bought some like 6 months or whatever. Sure, but the ones that they have it for 30 years, the ones that they hold for 30 years, 20 years, 10 years, 5 years, if they bought it in 2021, they're still down on that. End of story. Actually, KLL, she said something. So the banks can theoretically hold it together just as long as there aren't any bank runs. Yes, because
that's what actually causes you to liquidate. But the people taking the money out is, okay, I owe you the money, so I have to give you the money, but then I no longer need this collateral that I use your money to buy, because a bank, if, for example, I'm a bank, right? So you give me $100. I now have to go, and if I'm going to hold your $100, I have to buy $130 worth of a bond to insure it. So what I do is I do like a 40-60 split. I take $60 of what you gave me, and I go to the treasury and I say I want to buy a treasury, or a bond in this case. And basically I then have enough collateral to hold your $40. And then I go loan it out and do other stuff with it.
Right.
But then when you come back to me, I have to then, one, give you your $100 back. So now I have to go sell that bond that I bought that has now decreased in value, take the loss on it. Then I have to go take the money that someone else is lending me, same story that they have a bond in this, and I have to give it to you because your deposit is a on-demand request. Basically, anytime, any day, anywhere, you can redeem that deposit. So now you take your money. Now, there's some murmurings about insolvency and stuff, and you go out and you tell all your friends that are in the bank or that invest with that bank, hey, don't tell anyone, but you might want to get your money out. So then they go do it. And then slowly and surely, what are they going to do? They're going to go quietly take the money out. The bank takes more losses. And then they're going to call everyone they know. And then they're going to do the same. And soon, 2 turns into 4, 4 turns into 8, 8 to 16, 32, 64. You see how this is growing really, really fast?
Doubling is a magical thing.
Yeah, and you multiply to where the bank literally does not have enough money to go buy their bonds back. Or they can only sell their liquidity and they don't have enough money to then lend back to you, because that's how fractional reserve banking works.
Yeah, there you go.
They don't actually have their money.
Basically making money out of thin air. That's literally what that means.
Because remember, they lent the money that you gave them out to someone else, so they're all this, and you're literally like sitting there where they're saying, well, we don't have enough money to give you your deposit back, so here's whatever we got left. And then, by that time, everything's already gone down the waterfall. There's already bank runs and everything. Banks are shutting down. And if you saw some articles about SVB, people that were standing in line were basically told to leave, and the police were called, and they were escorted off and everything, and the bank just closed its doors. So it's really, now, like we said, every bank is susceptible to it. However, the big six, when we say big six, JP Morgan, Bank of America, Citi, Wells Fargo, Goldman Sachs, Morgan Stanley.
Okay, yep.
They're more equipped, per se, to handle it, meaning they can take more pain for longer. They can't take pain infinitely.
Forever. Yep, forever.
So usually the reason that a lot of people were scared, and to answer Steffi's face about why the banks, or why did the bleeding affect them, all the bank stocks, is because, one, people are irrational, and they took the method of sell first, ask questions later. So they panic, like every time in any crisis, people panic. And the first thing they do is they want to capitalize on what they have. Time is not your friend when you're under a stressful environment like that. So everyone's just pulling their money out like crazy because they're fearful. Humans are irrational beings where they basically, fear drives us a lot. And that's why you have volume capitulation rallies. That's why every crash is signified by volume capitulation. Is when everyone runs for the doors, you see that big volume spike, and that's the true bottom.
And you want to know something as well. Let's bring this to an even I guess more relatable kind of statement. The toilet paper shortage of 2020.
Oh God.
There was plenty of toilet paper. But because everybody went out to get one, or not get one, but get some, there wasn't any toilet paper left. That's pretty much that pretty much sums up the whole concept of like a bank run. There's enough money. There's enough money in the system. It's just that if everybody goes to get it, there isn't enough money in the system. Like there just isn't enough for everybody to get their own. But also, Y1 says, doesn't help that they all but removed the fraction they did need to have due to the pandemic, if I remember. I kind of understand that. Do you understand that?
Are you referring? No? I think he's referring to because during the pandemic they removed the. Yeah, okay, that was funny. All right, so they removed the requirements to actually hold collateral during the pandemic, so that banks could then have more liquidity and not really worry about the requirements to hold the collateral. But that was instituted back in 2021, coming out of the pandemic into 2022, where I think it was April of 21 or April of 22. I don't remember exactly. That regulation that Fatal mentioned was instituted back, that caused them to have the collateral, and then the banks basically, as rates were going up, did a mad scramble to get collateral because they had to meet that requirement.
Well, rates weren't back up. Rates weren't going back up in 2021.
Yeah, correct. Yeah, sorry.
Rates started going up in 2022. Yeah, rates started going back up in 2022.
They spent the good part of 2021. You had a mass influx of cash from the federal government and the Federal Reserve. So all that hit the banks. Now those banks don't need to have collateral.
And also, let me stop you as well. Also, I believe the savings accounts became checking accounts.
Yeah, everything they regulated it so the banks never had to hold collateral. Pretty much. So the banks have more money in history than they have ever had, and now they don't have to hold collateral. So they have debt, right? For a bank, your cash for a bank is debt.
Yes.
It's a liability. It's not an asset. The loan they give you is an asset.
That's the asset. Yep.
So basically now this thing comes back into effect. The overnight lending spike to where no bank trusted one another. That's what created the reverse repo facility, and where banks can literally park their cash to go get collateral. That's what happened because how that reverse repo was created. And so they have to institute all this collateral requirements because yes, banks were taking advantage of it. I'm not saying they were going like frivolously like 2008, just loaning everyone that had a pulse, but they took advantage of it. They said they didn't have to hold this collateral, so obviously they're going to take advantage to line their balance sheets to make sure that they come out with the best quarterly results. Any capitalistic business would do that. But now we've had this mass influx to get collateral at really, really expensive prices. Remember, bonds were expensive back then. And then the Federal Reserve goes on a 1.5-year campaign to basically obliterate any value those bonds had by raising rates. And you're now stuck between a rock and a hard place. Do you take an 80% loss on your collateral, or do you do other things? And as you see, the Federal Reserve is creating a new facility because the story is always this. They do something dumb, they wait for the consequences, then they create a facility to fix the stupidity that they created. So now that was reverse repo. And then now we're creating this other facility that banks can go park their collateral in and still can be considered collateralized, but they don't have to. The bonds are treated like if they're paying out at the maturity, and all this. I'm like, this is going to be a headache. But basically,
it's
banks
elongating the problem. It's elongating the problem.
All they're doing is the banks can literally go, and you're not encouraging the big banks. The big banks, again, the big banks have the ability to hold out for longer, so they're not going to necessarily take advantage of this, and also the structuring and all this. Like, they're not as, I'm not going to say greedy, but they're not as unwell managed per se. But then you go and these regional banks, basically you're telling them, here's a blank check, go have fun. You're encouraging rot in the system. So all you're doing is prolonging, similar how .com prolonged the debt in the system that created '08, you're just doing it all over again. You're just making more rot in the system so that the next collapse, the next deleveraging event is going to be way, way worse. Next time it will be the freaking big banks.
And the more that they'll have to do will be more, right? Every single time something happens, they always have to do a little bit more, just a little bit more to stave off a bigger collapse, and it'll just eventually, and it'll just eventually get to the point that I really do hope it does not end up with this. I really do hope so, but it will just get to the point where the government will just take control over the financial system. And in fact, we even have, and this is where pretty much we're going to end it right here with these tweets. Well, we got over here, Feds Bowman, the U.S. banking quote. This is a quote, by the way. The U.S. banking system has substantial liquidity and capital, and the Fed board is closely observing the developments. That sounds great, right? Great. They got liquidity and capital. Awesome. The problem is that in the same breath, U.S. Senate Banking Panel Chairman Brown, I hope the Fed does not change interest rates next week. So do they have liquidity or do they not have liquidity? Because which is it? Because if Chairman Brown is afraid of raising interest rates because it'll cause a liquidity crunch, why is the Fed saying that there's plenty of liquidity? That doesn't make any sense. Like, it doesn't.
Well, because the Fed, the thing is, everyone's like, you saw instantly when it was happening, they priced in a 40% chance that the Fed is not going to
that was ridiculous,
raise rates at all in March. And then today, when we got the CPI report where it still showed services and housing still being high, they repriced it to a 25. So it's funny. We went from Powell saying possibly 50 to all this fear coming back in the market. And then we went to 0 to cutting rates, back to 0, back to 25.
All in the span of 4 days. Wait. All in the span of 4 days, too. This is not like months. No. This is like from Thursday to today. That's crazy. Absolutely insanity. By the way, Y1 says the bigger banks also have the capital to serve as a buffer to buy time. Yeah, exactly. They do, but they don't have infinite. That's kind of what we were referring to in regards to the whole to this whole article over here. Sure, people may be coming back into like JP Morgan, Bank of America, and Citi because they are safer, but for how long, right? It's a ticking time bomb. That's all it is. If the Fed keeps raising interest rates, which it's part of the two mandates. It's part of the two mandates. So which one do you choose?
And also the thing of like, if anyone needs to be aware of this, you have Christine Lagarde coming out on Thursday. What is she famous for doing back in December?
I have no idea who that is. I have no idea.
That is the ECB. That's the Powell of the ECB.
Okay.
So the European Commission.
Oh, okay.
So remember in December, Powell comes out, gives this like two-legged speech where he gives one to the hawks, one to the doves, and then the market kind of just literally had no idea what it wanted to do. And then after close, 2-3 hours later, Christine Lagarde comes out and basically says, no pivot, get it out of your heads, higher for longer, interest rates going higher. And that's what created the December 14th sell-off in the market that dumped 8%. So the ECB, they're saying, the expectation is they're going from I think it was 100 basis point hike to now 75 to 50 and now 25. So that has a big market moving event possibly, but also again, the ECB is similar to how the Federal Reserve, it's a voting group. So I do think that they're going to stay the course with increasing rates. I just think the rate of increase because of everything breaking
will go down.
Because remember, everyone wants to say the Fed's not political and stuff.
Oh, they are.
But the thing is,
they absolutely are.
Yeah, they say we don't care about the stock market, but then they cite in their Fed minutes that if stock market goes up, we're going to have to keep increasing rates. I'm like, you guys contradict yourself on a daily basis.
Hourly basis. Get out of here. So Y1 says, yeah, but at least more than the smaller banks. Yeah, 100%. 100%. Yeah, the big banks do have enough capital and liquidity to stave off, I guess, this whole entire thing from going from going up. But the question is, how long? And that's, by the way, I don't have we don't have the answer to that. We have no idea how long. But
here's the counterpoint to that Stuff mentioned. He's like, if you saw what 2, 3, 4 banks, regional, right? So the big banks weren't even they weren't even brought up in the sense of like from a regulatory perspective. They were calm and collective sitting over there being like, yeah, where everything's fine. And you had a mass panic of all this. So what would happen if 6 banks all of a sudden come out? Because that's what you would see. You would see these regional banks getting hit first. So you're 100% right with that. But the panic would ensue because remember, the stock market discounts the future now. So if they're discounting the banks, the big banks, the top 6 are going to get hit by this, they're going to discount it now. So we saw gold.
They did go down. Not as much, but they did go down.
You would see circuit breakers get hit because you would be seeing that 50% haircut on the big 6.
Yep.
Like, now, how unfounded that would be if a bank fell 50% in one day, if it being the big 6. I'm not saying go buy a bank that falls 50%. We saw what happened with SVB. A lot of people tried catching that falling skyscraper of like, oh, it's down 78%, bought it, and then the dip gets dipper.
Okay.
But with it's like, if one of the big banks, the big 6, right? Mm-hmm. The country can't survive without them being here.
I would argue the world, my dude.
Yeah. If one of them fell 50%, not financial advice, I will be buying them like no tomorrow, because a 50% discount on a bank that already has a PE ratio of like nothing, with extremely like interconnections with all the financial workings of the country, the world. Yeah, that's going to bounce. It's the same way, like I always ask people about like the 1978 crash when the stock market fell 24% in one day. Would you buy it? I would take a stab at it. I think I would take I dip my toe into that market the same way like today when I saw Bank of America kind of holding down where it was, and same with Goldman Sachs. I'm like, I'll dip my toe in that. So I bought a couple put credit spreads on that, but I'm dipping my toe. I'm not going big in the position size. I'm like, I'm understanding the risk. Because, like, you know, if you guys haven't seen, take a look at the bank review video we did with the Big Six that we posted yesterday. It gives you all the, like, the key points of the big banks, kind of which ones we saw as strong, which ones we saw as weaker. But I did say Bank of America, it's a very, very riskier play, in my opinion, because you are so below a lot of support. But the way the price action's acting, I'm like, I'll take a little risk, right? So, you know, risk versus reward, and same with Goldman Sachs. And the algorithm's telling me buy here, look at there, and I'm like, okay, I'll position size small. But it's all about taking stabs at it. Now, am I going crazy like I'd be going in like if it was a 50% sell-off? No, I'm going in very, very small position size because you risk small so that if you have a big gain, it works out. But if you don't, you have a small loss. That's what a lot of people need to understand when managing risk. Like, you can play risky positions. It's just you can't go big. Like, if you're going in with 0.2% of your portfolio into a risky play, don't work out great. If it works out and it's like a 10 times profit of what you put in,
that's great.
Okay.
That's great.
It pays for all the other risky ones you did. So, like, you can, not to say you can't play risk, but it's also, you got to understand. It's like,
you got to understand the risk to begin with.
Yep. And also, there's another thing. Looking at the fear and greed index, we're still sitting in fear. We actually came out of extreme fear into regular fear just today. And I was like, okay, well,
actually,
we're right on the border of extreme fear.
Let me bring that up. Right here. You guys are seeing it right now. 26. So we're literally between extreme fear and fear. That's actually hilarious. So.
Yeah. So it's like, what does the famous person we love to follow say always? When people are greedy, be fearful. When people are fearful, be greedy.
And now, we're seeing this.
Yeah, it's like, that's when I get greedy. Well, I get greedy on both sides of the spectrum because I short the market when everyone's greedy and I long the market when everyone's fearful. So counter trending it, but I'm going to look at it like, now, don't get me wrong. I'm of the firm opinion we haven't broken something yet. We're breaking. We haven't broken something yet. And that's when your true Federal Reserve pivot comes, when something breaks. And when I mean breaks, I mean one of the big six is like declaring, hey, we're illiquid. The bond market goes illiquid. Any number of black swan events.
Actually,
personally, I don't believe this is considered a black swan event, because the way I define black swan events is VIX holds above 30. It got there, and it was like, for 5 minutes, it like teased everyone, and it was like, no, I'm going back down.
Well,
so you had to rush to insure everything because everyone, this is the first shock the system got in a very long time.
So you said we haven't broken anything yet. What's happening tomorrow?
PPI.
So let's see how that one turns out. The producer price index. Oh boy. Let's see how that one turns out, because I
want the chat to do something. If you guys think the
chat and VOD.
Yeah. So if you got they may use the cooling of CPI to serve as an excuse that they don't need to raise rates more than they already plan.
The problem,
not lower them, but just maintain. I could see that.
Yeah, except the problem.
No, I could honestly see that scenario playing out.
Sure. Except the problem, and I'll bring this back up. The problem is that, remember, the Fed doesn't look at CPI. The Fed looks at core CPI, and more specifically PCE. We have no idea what the CPI is going to come in at. And core CPI only went down by 0.1. You said it was 5.6 in February, and you said it was 5.6 in January and 5.5 in February. So CPI is the headline. CPI is what, CNN, MSNBC, CNBC use for like clickbait, right? I mean, it's what I use for even the video, right? Because that's what gets people to click. But the Fed does not, well, according to what they say, right? What they do, I don't know. But according to what they say, they don't follow CPI. They follow PCE and core CPI. And and according to according to the core CPI in relationship to January, it only went down 0.1. That's not.
But I could see, like, I think what Y1 is saying is, like, they won't shift their terminal rate. And remember, we're going to get that next week on Wednesday.
Okay. I got you.
You will know the, and Y1, tell me if I'm completely misconstruing what you're saying. So what I'm saying is, or what you're saying, or what I believe you are saying is, they're going to maintain the terminal rate. Is just the pace at which they get there is going to be the 25 basis point. You know, the original plan that we kind of mentioned there. We've gone full circle and we're back where we started.
Also, actually, yeah, they might actually do that because that also gives the banks enough time to maybe get more liquidity, right, in relationship to the collateral that they have. Because if let's say like it takes a year. You got it. There you go. So because let's say it takes a year for, let's say 50 basis points, it takes a year for them to reach their terminal funds rate, right? But if they cut it in half, it takes 2 years. Well, now the banks, instead of having a year to prepare for, you know, a terminal rate of whatever 5% or whatever it is, now they have 2 years. So now they have a lot more time on their hands to recuperate any kind of losses, recuperate any kind of liquidity holdups, that kind of stuff. So yeah, I could see that too. And
I'd be curious. And the thing is, you guys got to pay attention to, and I've always said this, you need to look at the last summary of economic projections and see if they're revising their targets higher. Because usually Fed pivots, like true Fed pivots, not what the mainstream media describes, where the Fed stops raising rates is when they stop increasing their targets. So what they do is they stop increasing their targets about 1 or 2 meetings before they're going to pause. And then the next meeting, they'll say, okay, we're not going to revise this again. We're revising it, staying the same. And then they raise rates. And then maybe on the third meeting, we're not revising it again. We're going to be stopping rates now. And that's when the market's going to do this mass rally. But here's my countervailing point. Does that mean that does fit the theme of kick the can down the road?
That's what the government is known for.
See, yeah, but
that's all the government is known for. Let somebody else take care of it down the line. Yeah, not me.
Until the thing is, it's like you're kicking nitroglycerin at this point down the road. The second you kick it, it's gonna blow up in your face. And I don't think the Fed's realizing.
Oh no, they know. They know.
Yeah,
come on.
They know.
Come on.
They know, and because they want it to crash. Like they've openly.
They just don't want it to be on their terms. They want it to be on somebody else's terms. The problem is that somebody else's terms is gonna do the exact same thing.
Well, the thing is, like, if we look at it like from a very, very like factual perspective, we're only seeing the effects of 2 or 3 25 basis point hikes.
Yeah.
We haven't even got to the monsters yet of the 75. We haven't seen the consequences of the 75s. So if we're breaking banks at 25 or 50 basis points previously, 2% terminal, 2% Fed funds rate, or 1.5, I can't remember what it was a year ago. But
yeah.
Speaking of, let me actually pull it up because I got it right here. So federal funds rate a year ago, which is March of 22, we were at the first 25 basis. So we haven't even. Their second rate hike was in April of 22. So you're seeing the consequences of one, or let's say 2, because there's a lagging effect between monetary policy. You're seeing the consequences of less than 0.5% federal funds rate.
So I have it pulled up right here, right now, and like we went from 0.08 to April. You said April, right? April 22.
Yep.
0.33, so a third.
So what's going to happen when we start seeing the concept? Like you're right. So banks are breaking, and that's one rate hike.
The small ones are the first to go.
Yeah. And what do you think's going to happen when we finally get to the monsters? And when did the monsters happen? Q2, Q3 of last year. So that's when you're probably going to see the massive unraveling, Q2, Q3 of this year, of when you see the consequences of those 75 basis points.
Because remember,
you're already seeing it
all of
forming on company earnings.
Right. All of these earnings are also, remember, a quarter delayed. So any Q2, the Q2 earnings are for Q1. So remember that. Just keep that in mind. But I pretty much just want to end it with one last thing, and it's actually in regards to the whole concept of somebody made a comment on one of the videos, and it has to do with the whole concept that the Fed's going to take over the banks, and then they'll it's a golden opportunity. And by the way, no hate. I forget your name that commented. I am so sorry, I forgot. But the person who commented this said that it'd be a great opportunity for the government to get into the banks, take control of it, and then fix everything, and then there is no loss to the taxpayer. Okay. The problem and the problem with this, and by the way, I can 100% attest to this because I specifically come from a communist country. I know what it is like, and by the way, boy, you kind of do too, but more of your parents. Yeah. I know this for a fact. There is nothing more permanent than a temporary government institution. The second that the government gets into any part of the economy, they will not let go. They will not fix it, for starters. They will actually keep breaking it more. And then they'll give themselves the excuse of like, no, we just need other parts. We just need more power because it's all the other parts that are actually breaking because we don't have control of it. If we had control of it, that wouldn't be the problem. They'll make that excuse and it will just keep getting worse and worse and worse. And then eventually you will get into a China-style kind of pseudo-capitalism, pseudo-communism where you literally have, in China, every single company is supposed to have a member of the CPP, the Communist Chinese, the CCP, the Communist Chinese Party, in the board of every single company. Now, I personally do not want that here because, I don't like communism. That's me. I am a capitalist, full blown. And, but that's essentially what a lot of people are thinking that this is going to lead to. Hopefully it does not. But that's pretty much all I'm going to leave you guys with is that you better hope that does not happen. Because I really am hoping that things just end right here when it comes to the whole banking collapse. Because the next thing that you will see is more government overreach. As you said, they'll make new institutions to fix the problem, and the other institutions will be bigger and bigger and bigger and hold more and more control over the economy as things get worse. So
yeah, it's like, ask yourself, did they fix 08?
No, they did not.
There you go. So there's your answer to it.
They did not. They made it worse.
Yep.
As Y1 just said, kicking the can down the road. So
yep.
Anyways, guys, I think that's we're pretty much going to end it right here. So yeah, thank you everybody for stopping by. We really do appreciate it. We do this once a month, pretty much on CPI Day. So hopefully everybody enjoys. And liked if you like, comment, subscribe. Really does help her with the algorithm on YouTube. I think SVB even got 2008 money. Probably.
It wouldn't surprise me.
I wouldn't. Yeah, I'm pretty sure every single bank got a bailout. But yeah, guys, liked if you like, comment, subscribe. It really does help her with the algorithm on YouTube. You guys can follow us on the YouTube sites, link in the description below, which, by the way, we're also live streaming on Rumble as well. And with that said, peace out, and we'll see you all in the next live stream or even video. Any last words, boy?
No, just be liquid going into PPI and make smart trades.
All right. With that said, peace out.